What if I told you that people who got a lower mortgage rate 2 years ago are now stuck paying more and still waiting to refinance? Or that some buyers spend thousands upfront on a rate buydown and end up moving before they ever break even? Let's break down the real pros and cons of a temporary versus permanent buydown so you can avoid common mistakes and make the smartest move for your situation. Hi, I'm Toni Taylor with Interconnect Mortgage, and I'm here to simplify a process that can feel complex, especially when it comes to creative strategies like buydowns. Let's start with the temporary buydown. The most popular buydown right now is the 2-1 buydown. In year one, your rate is 2% lower than your locked interest rate. In year two, it's 1% lower than your locked interest rate, and in year three, it adjusts your full note rate. Sounds great, right? Lower payments up front, often covered by the seller or builder, and you ease into your full monthly payment. But here's the catch, and this is what a lot of buyers were not told. You must qualify for the loan based on the full rate, not the discounted rate. And many buyers who got the 2-1 buydowns 2 years ago, well, they're now stuck with a high payment and they can't refinance because the rates didn't drop like they'd hoped. So if you're using a buydown as a short-term band-aid hoping for a better market, you're gambling, not planning. But temporary buydowns can still be smart. You're early in your career and you know your income will grow in the next year or two. Or you're only planning to stay in the home for a short period, maybe 2 or 3 years. They're not right for you if your plan is just, I'll refinance later. That's too risky. A permanent buydown is a different option. You pay upfront to reduce your interest rate for the life of the loan. It brings your payment down forever. It can save tens of thousands of dollars over time if you stay in the home long term. It offers payment stability and peace of mind. But if you move or refinance within a few years, you might not recoup the upfront cost. It's not always the best use of cash for short-term homeowners. So which one's better? Well, there's no one-size-fits-all answer. It comes down to your income, your timeline, your risk tolerance, and your plans. And that's where we come in. We run the numbers both ways, show you the long-term impact, and help you make a confident decision based on facts, not fear. If you want clarity on what makes the most sense for you, reach out. Let's make a move that matches your life, not just the market.